All right. Welcome everybody to our Friday night wealth creation course. I want to thank you all for joining me. Let me get Instagram up and live here. If you're just tuning in now for the first time, my name is Jerry. I'm the owner and founder of a company called Wealth Dynamics. And what we do is we help families and individuals become financially educated. We help them build wealth, and we help them navigate their economic futures with certainty, with the goal of those families and individuals then passing it forward. Okay. So that was kind of what I want to hit really quick tonight. If you're watching this and you've been tuning in before, I want to ask you to share the stream. Okay. So if you've been benefiting from the information, it's been helping you, share it, get the word out, make sure that you're getting plenty of other people on this, because we're talking finances. Okay. And we're not just talking any finances. We're talking finances in a way that is true, simple, and applicable. Okay. Which usually is not the case. If you look around at finances, most of the stuff you see in here is not true. Okay. The stuff that is true is not simple. And the stuff that is true and simple is usually not applicable. Right. And so we only want true, simple, and applicable because that is the information we can take in our lives and actually use. Okay. So that's what we're going to cover tonight. So if you guys are watching on Facebook, if you're on Instagram, if you're on YouTube, if you're on Zoom, regardless of what platform you're on while you're seeing this, again, my name is Jerry. My company is called Wealth Dynamics, and we are here tonight to talk about some money. Okay. Some financial education. Now, as we're diving into this, I want to let you know, we're going to be going through the very final chapter of my book, How to Create Wealth by Jerry Fetta. Again, that's me. Good to meet you guys. But again, we're going to go through the very final chapter in my book. So if you have this, you can follow along. If you don't have it, you can go to jerryfetta.com. You can get a free copy of it. We cover the shipping. You cover the shipping. We cover the book. That's how it works. So guys, without further ado, I want to dive into this. Now, before we get started into our topic, okay, a couple of things that I cover every week. Anyone ever felt confused when they're hearing about money? Okay, when you're learning about finances, whether it's terminology, whether it is, the strategies behind something, the vocabulary, anyone ever felt confused before? Okay, I definitely have. That's a big reason why I do this and why I teach people is money used to be a very confusing subject for me. What I learned is that money is simple. Okay, the reason why money is simple is because all of it is just math. All of it's just math. It's that simple. So if I know how to add, if I know how to subtract, if I know how to multiply, if I know how to divide, I can understand everything there is to understand about money. But where we get lost is vocabulary. Okay. So at the basic of money, we have math, and then there's a layer of vocabulary that's on top of the math. That is usually where we get lost. That's where I used to get confused. That's where I used to feel stuck. Honestly, that's where I used to feel stupid. People would use words I didn't know. And then I would be like, well, I don't know what that means. And I'm embarrassed to say I don't know what it means. So I'm going to just say nothing. Okay. And then I'm going to become antagonistic and critical about those that do talk about money because words that I don't know are stupid. That's how the mind works. Not picking on any one of you. That's how I did it. That's how everyone does it. So if there's something I go over tonight that you're like, wait, I didn't catch that. Even if it's the most basic thing. Okay. I want to give you permission. Ask. Okay, ask me what I mean. If you're in the comments, ask me what I mean. Ask for definitions. Ask for further explanations. If this is not so simple and easy to grasp, ask and get more clarification because I want to make sure this is actually stuff you can apply. Okay, so that's the first thing. Second thing is if you have any questions you'd like me to cover, drop those at the end. In the comments, I'm going to go over those all at the end. So if you have questions, leave them in the comments. I'll address those at the very end of our segment today. We're going to go for about 40, 50 minutes, and then we'll go with questions. As usual, if you guys are on Zoom, we will go live with your questions. So make sure you stay all the way through to the end. Don't leave me hanging on the microphone trying to talk to you while you're not on there anymore. So if you ask a question, stay through to the end of the chat. We'll go live with them. And then lastly is obviously be respectful, guys. We have people here that are trying to learn and improve their lives and their finances. If that's not you, that's totally fine. But you don't need to antagonize it and ruin for those that are. So if you're not interested in the feed, I totally give you permission to log off, go find something different, and leave this for the people that really do want to improve their finances. Now, without further ado, I'm going to cover our topic. I'm going to dive into this. Now, again, this is from my book, How to Create Wealth, very final chapter. This is page 56. Okay. Now, tonight's topic is all about doing what the wealthy have done. Okay, doing what the wealthy have done with their finances. Now, if we look at this, what I mean by that is there are certain methods of finance that successful people use. And I'm not saying like, if you don't use them, you're unsuccessful or you're being judged. But I'm saying if you look at someone that has good results with money, okay, there's some common themes that I would see if I started analyzing different groups and I start finding all of the people that are winning with money, meaning they're earning good incomes. They don't have a bunch of consumer debt. They have reserves. They have passive income. They have investments. They have businesses. If I were to categorize all of those people and survey and analyze their financial behavior, I would see a lot of similarities. Okay. Now, if I were to take people that weren't doing well with finances, like me 10 years ago, I didn't have a lot of income. I wasn't saving. I had debt. I had car payments. I had no investments. I had no financial literacy. If I were to take those people and survey their behavior with finances, I would see some similarities as well. Okay. Logic stands to reason with the successful group, their behaviors lead to the results they have. Right? With the unsuccessful group, their behaviors lead to the results they have, right? When I wasn't winning with money, before I was investing and doing all the stuff that I do today, even though I'm only 28, like when I was, 20, 21, that age, and I look back at my behavior, like there's no mystery to me as to why I wasn't winning with money at the time. Right. I wasn't working to bring in income. I wasn't learning about finances. I was spending my time on consumption rather than production. So I want to read from my book just a little bit, and then we're going to dive into a couple of concepts tonight. So this chapter is the very final chapter. It's chapter 18, Do What the Wealthy Have Done. Again, this is my book, How to Create Wealth. And I want to go through just a little bit of this. So this chapter starts out to say it is called the top 1% for a reason. Only 1% of the population make it there. If there was a group of people to study regarding money, it would be them. I have studied them in depth, and there are key traits of the top 1% of wealth. Okay. There are certain places they've invested their money. There are certain things they've avoided doing with their money. There are also key tricks that they have used when it comes to saving, taxes, increasing income, and utilizing debt. Wall Street is not sharing this information with you, and neither are banks. You certainly aren't getting it from your friends and family. And we guarantee your middle-class financial advisor or radio podcast guru isn't sharing this data either. So this goes on to say, could it be possible that only 1% of the population makes it into this group because the other 99% of people are studying the wrong sources and operating with the wrong information? Okay, I want you to think about that possibility. Again, we started this out today saying that money is just math, right? Money is just math. So if money is just math, then how come the math doesn't end up the same for everybody, right? Like if I were to do the equation 5 plus 7, right? 5 plus 7 would equal 12 for me. And if you did the equation 5 plus 7, 5 plus 7 would equal 12 for you as well. Doesn't matter our backgrounds, doesn't matter our opinions, it doesn't matter any of that stuff. The math is the math, right? So if you're doing 5 plus 7 and getting 12, and I'm doing 5 plus 7 and getting a different number, it's not that 5 plus 7 is broken. See, that's the conclusion a lot of us come to with money is we're like, well, this money thing is broken and it's impossible and you can't win at it and it's rigged. Well, no. 5 plus 7 is 12. The money is money. Math is math. Money is just math. So the math works. What is the equation? And am I doing the problem wrong? And based on how I'm doing the problem, where did I get my information about doing that problem? Right? So what I want to do here is I'm going to draw out kind of like a T-chart, and I'm going to just go through some different areas tonight, and I'm going to dive into, again, we're going to do top 1%, and then we're going to do bottom 99%. If you guys are on Zoom, by the way, you guys can see my screen. If you're on Instagram, you can't. So if you'd like to, go to course.wealthdynamics.com. Again, that's course.wealthdynamics.com. You can log in on Zoom. You can see the whiteboard. Bottom 99%. Okay, and I want to just compare some things that are different here. Okay, so as we're looking at this, we have two different areas. We could even split this further. Okay, we would have the area of the method, and then we'd have the area of the result. Same thing with the bottom 99. We'd have the method, and then we'd have the result. Method meaning how are they doing this thing, right? What is the protocol that they're following? And then what's the results of those protocols or those actions? Okay. So if we were to start to compare the differences between these, which I'm going to do tonight, we would see that there are some major differences. And we would see, obviously, that if we were to copy the more successful methods and more successful results, we'd get much of the same. Okay. So the first thing that I want to dive into, just because it's relevant, is I want to dive into the topic of investing. Okay, we're going to work our way backwards on this. I want to dive into investing. The reason why I want to talk about investing first is right now we have in the last 72 hours, we've had this Robinhood, GameStop whole deal going on. And I want to dive into why this is something that, you know, can throw us off if we're following the crowd on this. So again, let's look at the top 1%. The first result that the top 1% of wealth have that most of us would want, I believe most of you guys would want, is they don't have to work. Okay. So they don't trade time for money, right? They don't trade time for money. Most of us, the other 99%, have to. Okay. They don't trade time for money. This is not part of their equation. That's attractive, right? Like, who would like to wake up one day, let's say tomorrow, probably not tomorrow, tomorrow's Saturday, let's say Monday, you wake up Monday and you don't have to work. And it's not because it's a holiday, and it's not because you're homeless, and it's not because you're unemployed. It's because you have money showing up already. And because you have money showing up already, you don't have to go work a time clock. You don't have to go punch the clock and do the job for your boss, right? So that's the result that we want to have, right? I want that. Like I said, almost everyone here probably wants that, but we have to look at what's the method. Right now, before we compare the method, I want to look at, okay, well, if you look at the bottom 99%, they do have to trade time for money. That's very definite. Now, that happens at different levels, right? Some of us have better jobs than others. I've been a pizza guy before. I'm now an entrepreneur and a business owner. I've been a personal trainer. I've been an insurance guy. There's tons of jobs I've had, but they were all forms of trading time for money. Okay. So the result here, let me make that arrow a little more pronounced for you guys. The result here is this group has to trade time for money. This group doesn't. Why? Like, what is the main difference between somebody that has to work in order to prove and solve their financial means versus someone that doesn't? They don't have to anymore. Okay. The main difference is the method, right? Their method is investing. And their other method of investing, to get even more specific, is passive income. Okay, we've all heard of passive income before, right? Passive income is money that shows up from our investments that we don't have to work for. It's passive. It doesn't require any time to be traded, right? So the method to get to the point where you don't have to trade time for money is to invest and to produce enough passive income that our savings, our expenses, and our taxes are covered. And then we can wake up on a Monday and say, shoot, I don't have to work today. Okay. This is not like the sexy, like, man, you know, it's GameStop and Bitcoin. This is buying mobile homes and apartments and storage facilities and loaning money out and actually earning income, right? Now, here's the thing. These guys, you don't see them. Like, they're not usually on social media showing you what they're doing. They're usually just going and doing what they're doing, and they're doing it for their own families and their own freedom, right? So what happens is we see on investing, right? So with the bottom 99, they invest, but when they invest, they're investing for something called appreciation. Okay, I'm going to go over what that means. Okay, but appreciation is buying a thing, right? Let's say I buy this water bottle at a price, okay, and I buy it low, and then I hope that Daniel will buy it high. So I'm going to sell it to Daniel at a higher price than I bought for it. Okay, and I'm hoping that Daniel pays more money than I paid, and that way I get to make a profit on it. Okay, that's called appreciation investing. Now, the problem with this style of investing is it's speculation. It doesn't matter where you're doing it, it's speculation, right? So if we were to compare these, let me make a little bit of room here. If we were to compare these, again, I can invest for appreciation. Okay, I buy thing A, right? I acquire it. That's the first step. I buy thing A, and then I hope that thing A goes up in value. And then I hope that I can sell thing A to person B. And then I hope that person B pays more money than I did, right? And if that happens, then I get to make a profit. Now, appreciation investing can be very exciting. Why? Because you can buy something that was, you know, worthless or very low in value or price and then sell it for a very high price. An example of this would be the whole GameStop thing. Last week, I don't know, GameStop was maybe 20 or 30 bucks a share. Okay, I didn't actually even look. I just looked at it. Now it's like 300 or 400 a share. The graph literally looks like this. It's flat, 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 boom, like that. Right? So if I bought here and I sell here, that's very exciting, right? But here's the thing is I can't time this. Nobody knew GameStop was going to happen, right? Other than maybe the Wall Street firms that planned it, but nobody knew that this was going to occur. Okay, nobody could time the very bottom and sell at the very top. It's impossible. Anyone that says they can is lying, right? So if you notice, the wealthy, they invest for income. The other 99%, they invest for appreciation. Okay, appreciation, again, I'm buying low, I'm selling high. The problem with appreciation is I don't actually make any money until I get out of the asset, right? Let's say it's Bitcoin. I buy a Bitcoin. Okay, I buy it at 20 and it goes to 40. I'm going to be tempted to say I just made $20,000 because I bought it at 20 and it's now a price of 40. The problem is I didn't make $20,000 because I haven't sold yet. So if I buy it at 20 and it goes to 40, I have to exit at 40 and actually take my profits home. And at that point, I can say I've made $20,000. Otherwise, what I have here is I have paper profits. Paper profits, or even digital, if you want to call it that, digital or paper profits. Meaning on my account, it says I have money, but I don't actually have any money until I get more out than I put in. Right? The wealthy don't actually invest that way. See, what we see is these little clips on YouTube of these guys, these tech guys and these influencers, and they're talking about how they did Bitcoin and they did, GameStop and they did Tesla and they did this and they did that. What we don't know is a lot of these guys have already done the passive income. Like 10 years ago, they got to the point where they don't have to work anymore. And so, yeah, now they have money they can speculate with. Now they have money they can gamble with. Now they have money that they can put into appreciation investing. But they did the work and got to where I'm telling you, you need to get to and I need to get to first. They're just not telling you about that part because that's not the part that gets a lot of likes on their YouTube video. Okay. So when they get to the point where, yeah, they're financially free and they've got, hundreds of thousands or millions or even billions of dollars to play with, they can do whatever the hell they want and they don't have to worry about it because on Monday, they still have that paycheck coming in from all that passive income that they have. But we don't see that. We miss the context of it. So the difference here with the method, again, is the top 1%, they invest for passive income so that they don't have to trade time for money. The bottom 99%, they invest for appreciation and they still have to trade time for money. Okay. And if we look at examples of this, we've already covered some of them, but let me go ahead and cover a couple more that are maybe more real to the everyday person, because I don't think a lot of us are actually doing Tesla and Bitcoin. But let's look at a couple of these. What does the average person invest in? First one is the 401k, right? That's the first one. Almost everyone does. We've talked about this before, right? But the 401k, the entire basis of it is that my balance goes up in size and in amount, and then I can sell it when I'm 59 and a half, right? So that I can pull out more than I put in. 59 and a half. Let me clean that up a little bit. 59 and a half. That's my sell age. That's appreciation investing. Okay. Same thing with the IRA. If I put money into an individual retirement account, again, it's the same deal as the 401k. I buy it at one price and then hope it goes up in value so that when I'm 59 and a half, I can pull out more than I put in. That's appreciation investing. Okay. Roth IRA is the other one most people do. They're going to put money in a Roth IRA. Same deal. I can't touch it till I'm 59 and a half, and it's appreciation investing. No matter what, I can't have this money. Okay, like the house is the other one. Everyone does a house. They buy a house and they hope it goes up in value so that one day when they're old, it's either paid off or they can sell it. Okay, this one is more of a question mark on when someone does this, but usually someone flips and turns their house every 5 to 7 years. Okay, so these are the main things that most of us do with our money. And the problem here is that it doesn't work. the guy or the girl that has their money maxed out in a 401 and a Roth and an IRA and a house, they're not able to wake up on Monday and say, I don't have to work, because they're building the nest egg. The nest egg was sold by Wall Street and banks, right? So we have to look at which result would I rather have? Which result would I rather have? And based on the result that I would rather have, I need to follow the method that gets there. We know that this method does not get to the point of not trading time for money. And if it does, it's a very, very long time from now. Like I said, I'm 28. I don't really want to wait till I'm 60. Okay, a big part of my story is I was the financial advisor to my mom, and she died at 60. I set up her retirement account. I set up her investments, had everything planned out just like I'm supposed to. And then she turned 60, and 6 months later, she passed away. Right. So I don't want to wait till I'm 60. I have a lot of urgency for my own personal reasons of why I'm not waiting till I'm 60 to be financially free, which means I have to follow this method instead, because it's what gets me where I want to go. Right. So this is a big thing to look at. And when we look at this on the investing side, another factor that we look at, and this is very, very important. This is something that's been forgotten today with investments. The other factor that we look at is we have top 1%ers. They are value investors. This kind of coincides a little bit with the income thing, but here's the deal. Value means one of two things. Number one, value can be dictated off of an income stream. So let's say that I have a business or a piece of real estate. And let's say for the last 3 years, this business or this piece of real estate has paid me profits. Okay. And these profits, I can actually look back on my tax return and say, okay, great. I have this much in profit over the last 3 years. Based on that, I can make a reasonable assumption of what this business or this property is worth, right? Value refers to the worth of something. So that's the first way that I can invest for value. A good deal in the value investing world is a business or a property that is worth less than what the value should be. The pricing on it is lower than what the value stacks up to be. So let's say I find this property, I look back on the 3 years of income, and I find out this thing based on its income should be worth right now $500,000. Just making numbers up. But I see that it's listed for $350,000. That's a good deal, because I automatically get the $150,000 difference. Just because it's listed at $350,000 doesn't mean that it's not factually worth $500,000 based on its income. Okay, this is the way Warren Buffett invests. When he buys stocks, a lot of people are like, "Why just do the S&P 500 fund?" Warren Buffett doesn't do the S&P 500 fund. He tells you to do the S&P 500 fund because he wants market displacement. He doesn't do that himself. He looks at Dairy Queen and Coca-Cola and AT&T and these large companies, and he buys usually controlling interests in them. Like we're talking 10, 15, 20 or more % of a company. And he bases that off of what does their financial statements say versus what are they selling at per share. Right. So this could be done with a business. This could be done with stock. This could be done with real estate. That's a way to determine value. Right. So that's the first one. We could call that the income method. The other one is intrinsic value. Okay, intrinsic value is a little bit different. Intrinsic value means that we look at the actual raw materials and utility use of something. A good example of that, we could again use real estate, right? We have this property. Let's say that it's had no income. There's no history of any income. And I could look at this property, and I'm not saying to look at like market comparables and stuff like that. I'm saying, no, this has, there's materials, you've got roof, you've got well, you've got septic, you've got acreage. There's an actual bottom dollar cost or value to those elements in this property, right? So based on the actual real value of what's there, whether it produces income or not, there is worth there, right? Another example of this would be gold. Whether, regardless of price, gold has a value, right? You could say that about anything that's got utility value or material value. Utility value means it can be used. It is actually a useful thing. Right? Material value means it has some kind of raw material that you could resell. I have a buddy that bought a gym last year, right? He purchased the gym based on the utility value. Okay. Right now, at the time he bought it, it was closed because of COVID. So he couldn't look at the income. And if they sold that on income, they probably would have sold at a lower price because they don't know the future, right? Everything shut down. But my buddy went in, he said, okay, great. What's your equipment worth? How many weights do you have? How many sets of equipment do you have? What is the value of all of that stuff? And I'll pay you that or less. So he was able to acquire something based on value. This is called value investing. Top 1%ers, they are value investors. This is how they get wealthy. Again, there's a difference between getting wealthy and then staying wealthy, right? So someone gets wealthy by value investing. So that's a top 1% method. Now, if we look at the bottom 99%, again, they're not value investors. They are speculation investors. And you'll look at people that will follow, like, you know, hedge fund investors and Elon Musk and Mark Cuban and be like, yeah, but these guys, they say to buy Bitcoin and they say to buy this stock and that stock. Guys, again, they're already billionaires. So they can do that. You got to get to the point where you're financially free first. This is the definition of putting the carriage before the horse, right? So I don't speculate if I'm not financially free already. If I'm not financially free already, I need to be building a passive income and doing value investing first. Then I've got my freedom. Then I can go speculate. See, what somebody's trying to do though, when they're speculating, especially on like the recent stuff we're seeing, they're trying to find a shortcut. It's no different than a scratch off lottery ticket. It's no different than Powerball. It's no different than any of those things. They're hoping that they buy the right thing at the right time and they hit the lottery and that they can quit before and not have to do any of the work to become financially independent. But if you, and if you look at anyone that's in this top 1% group that has been around for a while, because you'll notice some of these guys come and go. Like they don't always stay in the top 1%. That's why I say it's not just about getting there. It's about staying there. The guys that get there and stay there, if you were to ask them or even watch interviews or read their books, they'll tell you how much work it was to get there. What they did to get there is very different than what they're doing now. Right? So again, the result is these top 1% guys, they're financially free. They got there through value investing and looking for income and looking for utility value or material value, right? Our peers, the other 99%, they're not doing that. They're speculating. Okay, speculating is, again, I'm buying this thing and hoping it goes up in value. Now, the problem with speculating is usually, like we've talked about with the income, usually there's no income, right? So speculation usually has little to no income. And there's also usually no utility value, little or no utility value. And same thing with materials, little or no material value. Let's use GameStop as our example here. Okay, so if we look at GameStop as the example and we say, okay, great. So what is the income being produced by GameStop right now? Lexi, could you Google that real quick? What is the earnings per share, the price or the PE ratio on GameStop? Stop. I'm gonna have Lexi look at this. Me and Lexi and my wife, we were looking at PE ratios, price earnings ratios the other week, and it's insane what some of the PE ratios are on these stocks and stuff.
It says it doesn't have it right now, but as of 2020, which is the latest, it's negative 5.38.
Okay, so the PE, so the PE ratio. Let me get Instagram fixed here. We're having a little bit of technical issues with Instagram, but the PE ratio on GameStop is negative. Meaning if you buy GameStop, it actually costs you money. They don't pay you income, you pay them, right? That's literally a negative interest rate in the lending world. Like imagine putting your money in the bank and earning a negative rate of return. That wouldn't be very fun, right? So if we look at this, like the PE ratio is negative, right? So it's got no income. Okay, we look at use value. GameStop goes under. You've got, what do you get? A bunch of old video games. Maybe you can resell those. Maybe you can't. I don't know, right? But there's not a lot of utility there. And who is my market? It's a bunch of kids. So unless I'm going to start my own GameStop franchise and business, there's not a lot of use value out of a silver CD, right? So there's not a lot of use value. Like it doesn't do anything special or provide any unique value. And then same thing with the material. Yeah, like I said, you might get raw material of video games. I bet they probably don't own a lot of their property. They're probably on leases. So I bet all you really get there is intellectual property, which is their brand and their website, maybe their customer list, and then you get their CDs. Okay, this is the there's a guy named Ty Lopez going around doing funds right now. That's what he's doing. He's buying broke companies that have no income, They have no use and he's just buying them for materials. Okay, companies like Dress Barn and Pier 1 Imports, these are not good investments. These are speculations. Okay, because what someone is hoping will happen is they're hoping that despite the fact that it has no income, okay, despite the fact that there's no utility value, despite the fact that there's little or no material value, that somehow they're still going to make money. Okay, with this type of investment, the only way that you can make money is by market displacement, right? So if you have this pool of investors, right? So these guys are all in there. The only way that this goes up in value is if more people enter than leave, right? That's the definition of a Ponzi scheme. If more people enter than leave, I make money. This is why I don't do Bitcoin. As soon as people leave Bitcoin, it goes down in value, right? So this is, you've probably heard me making fun of, it's called hodling, H-O-D-L. I'll talk about what that means in a second, but it's these people that they buy the investment. It's not producing anything. For the sake of it staying high in value, they can't sell, and they encourage others not to sell, and they encourage others to buy, because they know as soon as the sell happens and the investment starts going down in value, it's not going to go back up because there's no production, right? So this is something that if it flips, if this flips and we have more people leaving than are going in, it's just like a swimming pool, right? The water starts to lower. What happens when you're in a swimming pool and a ton of people get in the swimming pool? The water comes up. Okay, the pool looks really deep. It looks like there's a lot of room in there. And then you get in there and you're like, there's not a lot of room. There's a lot of bodies and sweat and dirty water. Okay, so then someone pees or farts, you leave the pool, everyone gets out, and the water starts to lower back down to its normal level. And then you see just how gross it was. Okay, so with speculation investing, this is the mechanics of how it works. Okay, I would prefer as an investor income. I would prefer value. I prefer utility use, like things that I can actually look at and say, this is why this investment is worth something. Okay, now the problem on this again is when people get out, they're only going to be able to get out to the degree that there are buyers that want to get in. So if the water starts getting low enough, couldn't you see that at some point prospective buyers are going to back off? They're going to say, whoa, that went from 400 a share down to 30. I don't think I want to get in. And then these guys that waited, the hodlers, they can't even get out anymore. And if they do, they've got to sell for pennies on the dollar. Now, what is hodling? Why do I keep saying that? This is not particularly relevant to what we're talking about tonight. But it is funny, so I want to share it with you. So this was in a Bitcoin blog. There was an investor that said that he was going to buy and hold. Okay, except for he spelled hold as H-O-D-L on accident. It was a typo. It didn't mean anything, right? So he's talking about with Bitcoin, he's just going to buy and hold. If you look at the history of Bitcoin, it went up in value like 2016, 2017-ish. I think 2018 is really when it peaked, and then it crashed. So if you were in those years, it was like 20,000, then down to like 9,000 and below, right? And so people that bought at 20, they didn't want to sell at 9. So they said, we're just going to hold. So this guy was saying, I'm just going to hold. So he accidentally had this typo, H-O-D-L. It's become this thing because someone determined that this is an acronym that stands for hold on for dear life. HODL, hold on for dear life, right? That is a speculation investor. This is stuck because that's what it is. You're holding on for dear life. Right? So this, I want to drill this one home because it's so important to get. Okay, investing has to be done at the right time, at the right place, in the right way. And if it's not, it can actually be worse for you than it is helpful, right? And a lot of the risk that comes from investing doesn't come from the investment. It comes from the investor and their lack of education. Or if they have little risk, it's because they have lots of education. Okay, so this is important to realize. Now, the other factor that I want to look at, if we look at this comparison on, again, how do the wealthy do things? Okay, how do the wealthy do things? The wealthy also do their saving differently. Let me draw a better line there. Okay, so they do their saving differently. So they have saving in money. Okay, so they save in money. right? And the result of that is they never lose money. Okay, wealthy people, they don't lose money the way we do. The bottom 99, we lose money all the time. Wealthy people, they keep a certain baseline that they don't ever go below because of how they do things. So they don't lose money because they save in money. Okay, now this is going to be so subtle, it might go over your head. Okay, the bottom 99%, they typically lose money or they never have money because their method is saving in currency. Okay, so there's a key difference. The wealthy save in money, the non-wealthy save in currency. Okay, what is the difference between money and currency? Okay, money is something that actually, again, has intrinsic value. So it can be used as a medium of exchange, but it actually has a tangible value, and it's a store. Like, it actually keeps the value and retains it, and it's of substance, right? So if we look at money, money would be things like gold, silver, right? Those are the original money. Different commodities have been used as money. Certain countries used to use wheat. They used to use corn. They used to use oil. There's all sorts of things that can be used as money, right? But that's actual money. It has real value itself. It doesn't represent value. It is value, right? What I mean by that is, if I were to give you $100, the $100 is not valuable. The thing you think you might be able to do with the $100 is what you would consider to be valuable. Versus if I gave you a brick of silver, that would be valuable. Like, it doesn't matter what you plan on using it for, silver is valuable, right? Like, anyone around you is going to say, yeah, that's silver, I'll take it, right? So the $100 is currency. Currency is a representation of money. It's a derivative of money, meaning it's a coupon. It's the paper that we carry around that says this is worth money, but it's actually not money. So the wealthy, they don't save in currency. Currency is US dollars. Currency is Canadian dollars. Currency is euros. Currency is yen. Like, any medium of exchange used by a country's government that's not backed by anything, that's currency. Okay, so the wealthy, they keep their money in gold. They keep their money in silver. They keep their money in things that have real value. And what that does for them is it gives them a bottom, like a bottom threshold. They're never going to go below a certain point, right? No matter how bad the US dollar crashes, if I own an ounce of gold, doesn't matter what country I go to, it's an ounce of gold. That doesn't change. Again, it's the numerator versus the denominator. The numerator is it's 1 ounce of gold. The denominator is how many dollars fit into an ounce of gold, which is dependent on how much the dollars are worth. If the dollars are worth less, then more dollars fit into an ounce of gold. Therefore, the price of gold is going to look higher, right? But if I'm saving in currency, I'm not actually saving in anything of value. What currency does better than anything is it loses its value consistently, no matter what, guaranteed, because it never had any value to start with, right? So the bottom 99%, they keep their money in banks. They keep their money in checking accounts and savings accounts and CDs. They keep their money in cash, right? Now, I'm not saying don't have those things. Like, you certainly do need to transact with something, but that's the thing. We earn and transact in currency, but we should save and retain in money. Major difference there, right? So if I'm saving in currency, if I'm saving in US dollars, the real inflation rate of a US dollar is -5% annually. That's since 1913. Dollar has gone down actually by about 5% every single year since 1913, right? So if I don't know that and I start saving in currency because I'm trying to keep myself, what are the reasons? Keep myself safe, right? I want to stay liquid. I don't want to lose money. Well, am I really safe if I'm guaranteeing a 5% loss every year? No. Okay. Am I keeping myself liquid if I'm guaranteeing a 5% loss every year? No, because my liquidity diminishes every year, right? So these are reasons why we save in currency, but the reasons aren't true. If I save in money, if I buy gold, if I buy silver, for me, I also do this with life insurance. I know that I'm not going to lose money. I'm going to gain money. Again, I know that no matter what happens with the dollar, this thing will be valuable, right? So this is a key difference. And if you can grasp this, again, it doesn't matter like the emotional attachment. It's what's the result? The result is I don't want to lose my money. I don't want to lose my purchasing power. I don't want to worry about inflation. The method is save with money. Okay, if I don't mind losing it, then yeah, I can keep saving in currency. But a lot of people, this is a big one. A lot of people won't do this because their friends and family do this. We have trouble getting our minds around the fact that the people we know still save in currency, that the bank says to save in currency, that our paycheck comes in currency. Okay, let me tell you what, the place we get our money from, called the Federal Reserve Bank, 80% of their reserves are gold. They're not saving in currency. They're giving you the currency, but they're saving in real money. Why is that? Okay, I want you to just look at that. Now, the other thing here we have is earning, right? So the result here is the wealthy. The wealthy, they earn a lot of money. They earn lots, right? The method is they are very big on exchanging. Let me fix my screen. I think we've got a little bit of a screen lag here. All right, we're back. Perfect. So the wealthy, we were talking about earning. So the wealthy, we were saying this is the 1%, and then this is the 99%. We're talking about earning. And we have our method and our results. Right? So the wealthy, they have the result of earning lots. They earn a lot of money. And the reason why they earn a lot of money is their method is exchanging a lot of value. Okay, now this is irrefutable. So think about, for example, Bill Gates, right? I'm pretty neutral on the guy. Recently, a lot of people think he's out to end the world, right? Maybe he is, maybe he isn't. We'll find out in due time. The Simpsons episode will probably tell us the answer to that. But regardless of what we think about Bill Gates, he brought value, right? This is how this was broken down to me. Even if Bill Gates was evil and he built Microsoft with the illest of intentions, a lot of people bought it. And a lot of people did good stuff on a Microsoft computer. And a lot of people continue to buy it. And that's why he was able to exchange value, even if he wasn't like in the intention of, I want to help people. I don't know if he was or if he wasn't, but I'm saying that even if his intention was not that, it's irrefutable that he did. So because he exchanged a lot of value with others, I'm going to add this. He earned lots of money. Okay, that's a key separator on the wealthy. Now, the bottom 99%, again, this is not a lot of us. This is not our fault. This is how we were conditioned, but it's a mindset we have to break out of. The result is we earn very moderately or very little. Right, so we earn moderately or little. The reason why is we exchange with ourselves or with no one. Right, I want you to think about the difference here. If I go to a job and I'm interviewing for a job and I'm the average person, what am I usually thinking about in that interview? Am I going to like the job? How much do I get paid? What are my hours? What are my benefits? How many vacation days a year do I get? Who are my coworkers? Am I going to like them? Okay, when do I get time off? Do we work on weekends? Right? These are all forms of self-exchange. I can't get wealthy exchanging with myself. Okay, let's take this idea and we practice it with another concept. Let's take a country, right? This is my crude drawing of the United States of America, right? So let's say we have America here. We got to put Alaska up there, right? This is the US. Let's say that we are trading and we are exporting goods, lots of goods, right? So we have all this stuff we're exporting, but we're exporting them to ourselves. We're exporting and importing our goods to ourselves, right? How profitable and how prosperous is that country going to be if they're exporting to themselves? Not very. Like, we have to have trade partners. Sure, we could produce our own stuff, but that's not exporting. That's just producing our own stuff, right? But if we're telling people, oh, we export this much money and we do this on, and here's all of our trade, But then the other side of the equation is we're doing it with ourselves. We're not going to have any sort of economic benefit with any other country. Let's say this is a company. Let's say this is my company. And I'm like, man, I want to sign up 1,000 sacred accounts this year. So I'm going to buy 1,000 sacred accounts from myself. That's not going to work. My company would go out of business because I cannot build wealth and earn lots of income exchanging with myself. Now, these are exaggerated concepts of doing this, but the fact remains is even though that's an exaggerated way of stating it, that's no different than going to a job and worrying about what's my hourly rate, how much do I get paid, when are my vacation days, what are my hours, what's my schedule, I don't like this, I don't like that. It doesn't matter. If you want to base your income off of what you like or don't like, you can be homeless and unemployed, and you probably won't have anything you don't like because you're not doing anything. Right. So that's the first thing that separates is wealthy people. They realize that it's about serving others' needs first. The money will show up. Trust me, if you serve enough people, the money will show up. But they're not basing it off of what they want. They really are looking at what does the marketplace want. Another example of this is Jeff Bezos. A lot of people, again, are on the Jeff Bezos hate bandwagon because he makes so much money. Maybe he does, maybe he doesn't. But the irrefutable fact is, and you can research this, he's obsessed with customer experience. The guy, like, he totally serves his customer. Doesn't matter what you think of him or his politics or how much money he has or what he does with his money or if he's extorting the COVIDs or any of that stuff. Like, the guy is obsessed with serving other customers. And it shows in his product. Amazon is super easy for me to order stuff and get it delivered, and it's hassle-free. And they recommend, based on what you bought here, you should check these things out too, because he understands my wants and needs. He understands your wants and needs. Right? So he earns a lot of money because of that. Okay, now what about this other factor, exchanging with no one? Let's talk about that really quick. What does that look like? Okay, exchanging with no one, and this one is going to be easier for me to draw. Exchanging with no one is the GameStop Bitcoin mindset. Okay, I wrote an article this week that talked about, again, this thing called the triangle of wealth, right? Earn, save, invest. And it goes like this. We earn, and then we save, and then we save, and then we invest. And these investments should produce more income, and it strengthens the earn. And it just goes around and around and around and around. And at a rapid pace, it starts to expand. Okay. So exchanging with no one is when I try and buy an inanimate object and get rich off of it when it doesn't produce any value to anybody. Right? Like taking advantage of like a share price. Not saying it's wrong and it's impossible, but I'm saying the exchange benefits nobody. I'm not adding value to anybody by doing that. Right? So if I want to make lots of income, and I'm going to add predictable income. If I want lots of predictable income, I have to exchange lots of value with other people. That's going to help me build wealth. That's going to help me become a top 1%er. Okay, again, that's the bottom line. You can look at McDonald's as another one. Super unhealthy, crappy food. I wouldn't recommend it. Will probably give you cancer and diabetes, but people for some reason love it. And it's valuable to them. And McDonald's understands that. And they're very good at delivering the product that their customer base perceives as value in very large mass quantities. That is exchanging value with others. Now, again, that's a perfect example. I'm sure that there are executives at McDonald's that won't eat the burgers because their personal opinion is that it's unhealthy and that it's not good for you. Okay. But regardless of personal opinion, someone else doesn't think that, and someone else wants it and needs it, and they're going to buy it. And so that's where you've got to look at, I'm not exchanging with myself. I'm exchanging with that guy. Right? If I'm exchanging with that guy, my opinion doesn't matter. It's what is his opinion. Okay. So this is how we separate ourselves here. Now, the final one that I want to go over is education. Okay. Education. We talked a little bit about this last week, but again, this is another comparison. So we have education as our topic. Okay. So the result of the top 1% on education is extreme financial literacy, right? They know almost everything there is to know about money. They know about taxes. They know about investments. They know about where to save. They know all this stuff that for us, we call it loopholes. When we learn some of the stuff the top 1% do, we have a tendency to be like, oh yeah, that's a tax loophole. No, it's not. It's the tax code. If you read it, you would know what it says too. It's not a loophole. It's there for everybody, right? Now, here's the thing is the method is self-study and experience. Okay. The top 1%, they become educated on money by self-study and experience. Okay. Now the bottom 99%, this is the entirety of the rest of America. The result is, I'm going to call this confident financial illiteracy. Right? Confident financial literacy. I was having this thought yesterday with all, like, this is the craziest time to be alive financially because there's so many just weird things happening. There's Bitcoin and GameStop and stimulus checks and PPP loans and bailouts, and the stock market's been propped up for freaking 2 years now. And it's a crazy time to be alive financially, but I've never seen so many people who think they know what they're doing. And they don't. And you can tell by their results, and you can tell by what they're doing, and you can tell by watching their behavior, but they will chew you out in a comment feed because they're so confident in what they're doing. I call that confident financial illiteracy. There's nobody more confident than the idiot. Like there's literally, guys, there's literally Bible verses written about this. Like, it's such an old truth. There's nobody more confident than the guy that doesn't know what the hell he's doing. Right? So the result is confident illiteracy. What is the method though? Opinions and copying. This is literally the definition of monkey see, monkey do. Okay, the majority of America, they learn about money from opinions. Mom's opinions, dad's opinions, brother's opinions, sister's opinions, teacher's opinions, coworkers' opinions, God forbid, college professors' opinions, like all of these people that don't actually have money that we take our opinions from, right? Not only that, we copy them. Okay, we see somebody do something on Instagram with money. We're like, oh, that must work. He's got a Lambo and a watch. I need to do that too. Right? Or we see something, just a little glimpse of a little snippet of what somebody said that seemed like it kind of maybe made sense, even though we didn't have any of the rest of the context, and then we copy it. And the result is we're very confident because, after all, we watched it and we know that person, so we believe them. And so we go about our merry way making bad financial decisions with complete illiteracy, but complete confidence that it's being done the right way. And here's the thing, is the result that we have directly conflicts with the fact that we're right. If we were right, we would be better off with finances. If we were right, we'd have more money saved. If we were right, we'd have more investments. If we were right, we would have more income. If we were right, we wouldn't be losing money in the stock market. If we were right, we wouldn't even care about what was happening with GameStop because we would have our own stuff to be doing. So we can't be right because our results aren't right. Right? That's the way you test, is this the right information? Is it working? Right? So what do we do here? And I'm going to open this up for questions now, but what do we do here? We have to really look at, what do the wealthy do? Right? What do the top 1% of wealth do in these categories? And we have to be willing to say, all right, this is not what I was taught. This is not what I was, growing up on. This is not what my parents believe or my friends believe or my family believes. My coworkers might think I'm weird. Heck, my spouse might even think I'm weird if I do this stuff, but I can look around and see that it works. Okay, we've got to be confident in seeing other people's success. Now, this is when I'm going to end on this note, but guys, what is the trend right now when other people are successful and we see it? The trend right now is to hate. The trend right now is to make them wrong. The trend right now is to be critical of them. Those are the people we should be learning from. The reason why we don't learn from the top 1% is because we hate on them. And we talk about how evil and wrong they are, instead of looking at, wow, they have results that are literally thousands of times better than mine. Maybe they're onto something. I should try what they're doing. No. Instead, we're going to make them wrong. Okay. So there's two ways that we can go about doing this. Number one, we can look at, what are the top 1% doing? Do you know a top 1%er that's honest, open, and transparent? Now, the easiest way to get somebody honest, open, and transparent is read a biography about one of them that's old and dead. If you find a top 1%er that's old and dead, you can read their entire biography without any sort of opinions or gaslighting or different lens or perspective that someone's twisting it through. You can just look at, they were born on this day, they did all this stuff, and then they died this day. What looked like it's simple and works that I could try in my life? Right? So that's a way to do it. Now, a lot of these top 1%ers are not transparent. You don't have a biography on everybody. So what else can you do? Well, it's called, again, top 1% for a reason, like we said in the very beginning of this chapter, which means 99% of people aren't making it, right? So if I can't pick a top 1%er, what I could do is I could just look at the 99% of 99% of people and do the opposite of what they're doing. And if I just did that, I would probably be pretty close to being in the top 1% of behavior just by doing the opposite of what my friends, family, and peers do. That's a very valid way to start until you start getting more information on what are the top 1%ers, where are they, and what are they actually doing. So look around. 99% of people putting money in the 401k probably means you shouldn't. 99% of people financing a vehicle probably means you shouldn't. 99% of people putting money in the stock market probably means you shouldn't. 99% of people, their biggest asset is their house. Probably means yours shouldn't be. Right? I have to be willing to look at that, though, and be unbiased and unemotional in my decision and just say, yep, this is what works. I'm going to do it. Okay, because there's a lot of things we just made wrong. The 401k and the stock market and the bank and the house, all the stuff we were taught is the holy grail that we should be doing. And we're just looking at based on behavior and results, we probably shouldn't. Right. So what I want to do is I'm going to open this up for questions. Unfortunately, my phone died, so we don't have any Instagram comments. So we're going to have to go without the weird sex phrases and strange things that usually we have the privilege of reading on the Instagram products. All right, let's see what we have on Facebook first. And again, if you guys are on Zoom, drop your comments in Zoom. I'll answer them live. If you're on Facebook, drop them in Facebook. I'll answer them live here as well. Tyler, good to see you. Michael Kerrigan, good to see you. Michael says this is a swimming pool that someone pooped in it. I'm not sure what Mike's talking about, but I think he's tying that hopefully into something I said and not a literal happening around him right now. Mike, if there is a swimming pool that someone pooped in, don't get in it. Just got to cover that base. Jose, good to see you. He says education or lack of education is what makes something dangerous. That's totally true. Todd, good to see you. Money versus currency was Todd's takeaway tonight. Michael says if someone took tonight's course and they applied it, they would completely change their financial condition permanently. That's true. That is the point, and that is the challenge for you. If you watch this tonight, you could change your life with this information right now. Justin says money is only meant to be saved to a certain amount that allows you to put it into a cash flowing asset. Once you get that amount, you dump it into an investment and go broke again and repeat that process until passive income exceeds earned income. Good. That's very true. Now, I would add to that, you do it until passive income exceeds savings, expenses, and taxes, because my earned income could be like $2,000, right? So we want to actually base it on savings, expenses, and taxes, not earned income. Mike says, Mike agrees. Justin, there's nobody more confident than the idiot. There are too many of those people out there. I agree with you. Mike, that's gross, man. Mike says the poop is in the hot springs. Those aren't hot springs, Mike. I don't know where that's at, but that's not hot springs. Let me go ahead and cover our questions here on Zoom tonight as well. All right, let's see what we have on Zoom. Good to see everybody tonight. All right, Zoom questions. Again, if you guys have questions on Zoom, drop them in the comments now and I will go live with you. Okay, Avery has a question on value investing. Let me go ahead and bring Avery on live here. All right, so we're going to go live with Avery. We're going to go ahead and unmute his mic here. All right, Avery, we have you live. How are you doing tonight?
Doing well this evening, Jerry. How about yourself? Can you hear me?
I can. Can you hear me okay?
Loud and clear.
Awesome. So you have a question on value investing, is that right?
That's correct. Just curious to know some of the best books you've read on value investing yourself?
Yeah, so my two favorites on value investing, the first one is going to be called The Intelligent Investor. That's written by Benjamin Graham. That book is a classic. It's very thick, but that's the book that Warren Buffett basically learned how to invest with himself. So Benjamin Graham wrote that. And then the other one is called The Warren Buffett Way. And that's another one that really dives into Warren Buffett's philosophy. So that's a great one. In the stock realm, if you're in the real estate realm, a great book is The Millionaire Real Estate Investor. That's by Gary Keller. And that kind of talks about real estate investing. And those are probably the best ones on value investing. And then outside of books, a great way to go about learning about value investing is studying balance sheets, looking at financial statements, looking at price earning ratios. If you're in real estate, looking at cap rates, looking at net operating incomes, basically just studying the numbers. And that's one of the best ways to see value investing. A great example of that, again, price earnings ratio. It's kind of like the yield on a stock. I think AT&T has a price earnings ratio of like 8%, which is super strong. It means if you buy AT&T, they're paying a good income versus, I think, was it Apple or Netflix? Lex, that was like 97% PE. Netflix was like 96 or 97%, 96 or 97% price earnings ratio, which means they have almost no earnings. Okay. Netflix price is way up there, but they're not paying you anything. So those are like practical things you can look at on price earnings and value investing. Very good question, Avery. Let's see here. Casey says the chlorine should kill it. Hopefully it wasn't alive in the first place, Casey. We're talking again, I think about Mike's poop. Hopefully there's nothing to kill. All right, Casey has a question here. Let me go ahead and bring Casey on live. All right, Casey, you are live with us. Let me go ahead and unmute your mic here. Hey, Casey, can you hear me?
So, you
can't hear you quite yet, man. Can you hear me now?
I can hear you, yes.
Awesome. How are you doing tonight, Casey?
I'm doing good.
Great. So you have a question about top 1%ers.
Yeah. So you say work is exchanging time for money, right?
That's right. Yeah.
Yeah. But you still see like Jeff Bezos and other big company like CEOs and stuff, they're still working and they're out there. So is that not what you mean, or do you?
That's a good question. So Casey is saying when somebody gets wealthy, you typically still see them out there working. Typically, like you see Jeff Bezos guys still working. Warren Buffett is still working. Now, what you'll notice the more you study wealth, and this is something that I came across myself as I started studying, because I asked myself that same question. So I was like, okay, if I get to a point where I no longer have to trade time for money, what am I going to do with my time? And I thought about that, and I thought about, well, I could travel and I could vacation and I could do this. But the reality is there are things in life that I'm passionate about that might still be considered work, because it's not playing, right? There's like some kind of a purpose or mission behind it. And I would still do those things. For me, like helping people with finances, even when I'm financially independent, I'm still going to do that, right? I would say Bezos at Amazon is probably his passion, and what he does is something he loves and he's going to continue doing regardless of the money he makes. Now, the neat thing is he'll continue making money because it'll continue being valuable. But with these guys, when they get to that point of being wealthy, they're not in it for money. They're in it for a different reason, and money is just a byproduct. So it'll still show up, but it's not the purpose, and it's not something that they're tied to. And then the flip side of that is he could stop also and be totally fine. So that's the question is, again, it's financial freedom. Freedom, could I stop? If I couldn't stop, I'm not free, right? So Bezos could, Buffett could, they choose not to, and that's part of the freedom that they have. So very good question, Casey. That's a thought-provoking one, and one that I've thought about myself. Okay, Nano has a question here. Let me go ahead and bring Nano on live.
Hey, Jerry, can you
All
hear
right.
me?
No, I can. How are you tonight?
Doing great, man. You?
I'm good. Thanks for asking.
Awesome.
What is your question?
Okay, good. So, can you explain the importance of having a process to follow, such as a blueprint, for example? Why the need to quote unquote be solvent first, debt free, then work on my credit so then I can invest? Why have that in sequence? This is, I do have an understanding, but as I do have some people here that I've been talking to, but for also to them to have a sense of understanding why that needs to occur or have a process to follow in order to get there.
Good question. So this is one that I'm going to do the whiteboard for. We talked a little bit about this previously, but basically what Nano was saying is the different phases of the blueprint. Like first I need to be educated, which means I've actually got to study equals study. There's always action behind each of these steps. So I've got to study and get educated. Second, I need to be out of consumer debt. Now, this is where some of us might get a little ridged on like, well, I don't want to be Dave Ramsey and yada, yada, yada. Okay, don't forget Dave's even a thing, okay? Let's say I have $10,000 in debt. Not that much debt, right? 10 grand, like that's a fairly small amount, right? But let's say that this is a $200 a month payment that I'm going to pay until that debt's paid off. Let me fix my month signal there. Okay. Now let's say that I also have $10,000 in cash. And I'm like, well, I could pay off my debt, right? And then I'll be debt free, or investing. Investing sounds more exciting than paying off debt. So I would rather do the investing. Okay. Let's say that I'm really good and I can make 12%. Okay. Simple math. I went to Houston High School. I did not go to college, but I know that $200 is more than $100, right? So the reason why we pay off debt first is the debt will give you the most amount of income back, even more income than you would get if you invested instead. Okay. Now, the other thing is with debt, like when you understand the banking system and you understand how it works, you're going to understand that this 10 grand that they loaned out to you, they didn't have it in the first place. They loaned you nothing of it's a real nothing, and they're getting real income from you in exchange for nothing, for digits on a screen. So we want to get out of this first. Now, the definition of solvency is another thing that we look at, right? So who would agree with me that if you're insolvent, you can't be wealthy? You've never heard of a wealthy person who's insolvent. The two things don't go together, right? If you look at the definition of solvency in the dictionary, you can sum it up with I earn more than I spend and I own more than I owe. Okay, again, probably 90% of Americans don't do that. So if I just jump into investing and real estate and all of these kind of gimmicky sounding things, and there is a time and a place for investing and there's a time and a place for real estate, but they're not the object. Okay, they're a means to an end. The end is financial freedom, right? The end is not to be a real estate investor. That literally means nothing. I can show you dozens of real estate investors in Anchorage, Alaska, where I'm from, where that's all they have. They're not profitable. They don't make cash flow. They're real estate investors that are broke. And God forbid something breaks on their apartment building, because they'd be out if they did, right? So we need to get debt free. Then we need to build up reserves. Okay, like why would I be in a position where I've got all this money invested, but if I miss a paycheck, I go under? Right, so that's why we'd have reserves. And then from there, we protect our liabilities. We insure ourselves. We set up our entities, our estate plans, liability protection. Again, why would I buy real estate and invest if one little needle could poke my balloon and blow up the entire thing? Right, like think about like financial freedom. I'm funding my lifestyle here. This is the vehicle for my freedom. This is the car that my freedom is going to drive in. Okay, I'm not going to freaking drive around in a hoopty. I'm going to make sure that I've got a good car. It's solid, like no different than if I had kids and I was shopping for a new vehicle. I wouldn't be trying to take shortcuts. I'd be looking at, no, what's the thing that's actually going to get the job done the right way, because I don't want to risk it. So these are all things that we look at. And then once we've done this and we've built this up, then we can start acquiring assets. We can start investing to get passive income. And then we can get into more advanced, sophisticated strategies. And then we can become accredited. But this all happens in this gradient for this reason. Now, if I don't do this, and I skip this, and I skip this, and I skip this, and I skip this, and I'm like, man, I read Jerry's book, and this sophisticated stuff sounds cool. I want to do that. Well, I can't be sophisticated, and excuse my bluntness, I can't be sophisticated if I'm a dumbass. Like, if I don't know about money, I can't be like, I'm a sophisticated investor. No, I have to be educated. Okay, I can't be sophisticated if I'm loaded down in consumer debt and I'm out spending any passive income that I hope to earn through my investments because my payments on my debt are so high, right? I can't be sophisticated. Like the investments on this sophisticated level, if you don't have reserves and can't prove reserves, they actually look at you as a liability to the fund. You are the guy that's probably going to whine and ask for your money back as soon as COVID happens because you didn't have reserves, right? Same with liability protection. You get into an investment like let's say a real estate deal, and you don't have liability protection. This step here where you're back in debt. So this all happens for a reason. I'm glad Nano asked that question because it's exciting and it's very fun to build financial independence, but it is a process, right? It is something that we have to do it the right way. There is a sequence. Most people skip that sequence, just like most people are broke. Goes back to what we said tonight. 1% of people are doing it right, 99 aren't. So the guys that we see around town in our neighborhoods, on all of our peers are part of the 99%. We probably don't want to be doing it their way just for sake of they're not in the 1%. So I hope that answers Nano's question. Very good question. Yeah, absolutely.
And it wasn't so much for me because I see a lot of new faces here because I've seen you talk about this multiple times. So
totally. Good question. Let's see what else we have here. Okay, this is a question from Brad here. Let me go ahead and bring Brad on. All right, we have Brad here live. How are you doing tonight, Brad?
Awesome. Hey, this is getting really interesting. My question is, what are your thoughts on the Federal Reserve buying up all these assets made up of fake currency? I mean, and then how do you think that's going to affect the 99%? I mean, this thing is getting really interesting. I thought 2020 was interesting. I'm thinking 2021 is going to be real interesting.
Yeah, good question. So what Brad is talking about here, and I'm going to draw this out as well, is so last year, we had the crash, right? So March, and the economy just totally tanked. Gross domestic product crashed. And so what we have here is we have the Federal Reserve Bank. We're just going to call them the Fed. Again, realize the Fed is not federal. It's not a reserve, and it's not a bank. It's a private institution that basically indebts the United States government to it. And then we pay for that debt and the interest on that debt through taxes and inflation. But what they're doing is they're creating money out of thin air, and they are using that to buy assets from corporations. So they're bailing out a lot of these companies that are on the verge of bankruptcy, that can't service their debts anymore. And what that's causing is it's actually causing a binary economy, right? So we have goods and services, and then we have assets. Now, when we increase currency, meaning when we print money and we flood the economy with it, that increases pricing, but it increases pricing of the things that we aim it at. So think of it like a gun, right? Whatever I point at and shoot is the thing that's going to increase in price. Right now, the Fed is shooting at assets. Okay, perfect example. The stimulus checks came out in 2020. Each of us got $600, right? But the total amount that was if you divvy it up on the total amount that was in stimulus, it comes out to like $6,000 per citizen. Where did that go? That went to corporations. Didn't go to us, right? So the money is going to assets. It's inflating the asset prices. And so these companies are experiencing prosperity. Their share prices are going up. Their valuations are going up, even though their earnings aren't there. Like we talked about, GameStop's earnings is a negative 5 PE ratio. Netflix is like 97 PE ratio, right? If you read Intelligent Investor by Benjamin Graham, he'll tell you like a PE ratio that's on the verge of being too high is usually around like 20 or 30 is like on the verge of like, yeah, we're too expensive. So 97, terrible, right? So we look at the assets, they're inflating in price, right? Now, goods and services aren't because people are still broke. So what we're seeing these are stagnating and in some cases going down. And so people are basically having deflation. The 99% are having deflation, while corporations are having inflation with their assets. And so it's creating two worlds. We're starting to see the middle class really is starting to be on the verge of sliding off and disappearing. And soon we're going to see, I have a client that's a realtor on the East Coast. She's like, yeah, it's getting to the point where we're having bidding wars because there's so many properties being listed, but the prices are so high and there's so many buyers trying to compete at that price. If that kept going up though, what's going to happen is, let's say that property, for example, is going to be priced so high that the buyers can't afford it. Right? So the average person that's not a top 1%, they're not going to be able to buy a house. They're not going to be able to own stock. They're not going to be able to afford gold and silver. Okay, they're going to be looking at, how do I just pay for bread and meat to put on the table and buy my groceries? Now, this is not doom and gloom. Like, this is just economics. There are solutions to it. And a lot of what we're talking about tonight are those solutions. But this is the inevitable future of what will continue to happen if we don't change something. So excellent question, Brad. It will be interesting to see how much further this gets. Let's see here. Casey has another question. Let me go ahead and bring Casey back again. All right, Casey, we have you back here. You should be able to unmute and ask your question here. Oh, I thought I heard him. You there, Casey?
Hello.
Hey, I can hear you. How are you doing? Good to talk to you. It's been like 2 minutes.
I know, so much has changed. Time is money. So roughly, obviously, it's different for everybody. How long does it take to like start getting to that point of receiving, like getting that passive income, so it's covering your income, your reserves, your taxes, you know, all the stuff you talked about, versus like the 30, 40 years for the Roth IRA or 401?
Good question. So timeline is something that's going to be unique to everybody. But again, this comes down to, again, your own plan. So if you look at, like, for example, let's say I have debt. I'm not going to be able to do the investing till I get out of the debt first, right? Or I have no debt, but I've got no reserves, or I don't have money to invest. So it doesn't have to take 30 to 40 years. I think most people can get this done in 10 to 15 years if they really work at it. And you have to factor in, if you follow the blueprint that we have, you're getting rid of all of the consumer debt. That's all money you can save and invest. We're getting your taxes down as low as we possibly can. That's all money that you can save and invest. We're reducing your housing costs as low as we can. That's all money you can save and invest. We're teaching you how to increase the income. We're taking all that money we've been saving, and we're usually arbitraging that with life insurance or gold, and then putting it into income producing assets. So we're earning double returns on most of this stuff. And so if you do that over and over and over, it starts to compound just like a compounding interest rate would, but it's compounding cash flow instead. And so it's hard to say how long it takes. I think the average person can and should be able to do this in 10 to 15 years, if not sooner. I have clients, like, for example, I have a guy in California here. His name's Daniel. I think 12 months after working with us, we increased his net worth by 200 grand. And his passive income, which he had none of, he's now got several $1,000s a month coming in. Daniel freaking went out and hustled, right? So it can take as short or as long as you want it to. But that's the nice thing, is you have control. With this type of plan, you have control. With the Roth, you've got no control. You've just got to wait till you're 59 and a half and then hope that you're in a good shape and that you die before the money runs out. So again, that would be more of a question of timeline that maybe you get with our team on, and they'll be able to help answer that specifically. I think 10 to 15 years is reasonable. And from what I've seen, you can get there even sooner if you really work at it. So excellent question. I think we have a couple more on Facebook here, and then we'll wrap up if there's nothing left on Zoom. Okay, Gene has a suggestion on a book on value investing, Avery. Gene says, if you read a book called Rule Number One, it's by Phil Town, and it's again about Warren Buffett style investing. Now, guys, I want to just hit on the Warren Buffett thing. You guys will see tons of stuff on Warren Buffett when you get into value investing. Warren Buffett is extremely downplayed right now. The reason why is he doesn't get into Tesla. He doesn't get into Bitcoin. He doesn't get into GameStop. He's literally been doing freaking the same thing since the 1930s, over and over and over and over and over again. So if you study him, his story is really impressive. And like I said, we want to read about old dead guys. Warren Buffett's in his 90s. In some of his interviews, I wonder if he's wearing diapers or not yet. Like, he's that old. And he probably will pass away in the next couple of years. And soon he will be an old dead guy. Elon Musk, I don't know if he finishes wealthy. I don't know if Jeff Bezos finishes wealthy. I don't know if Bill Gates finishes wealthy, right? But these guys that are that close to the finish line, or the ones that have already crossed that finish line, that's who we want to study. And those usually aren't going to be the most attractive people in pop culture, but they are the winners, and those are who you want to pick. So I think that's all of our question, guys. What I'm going to do is I'm going to go ahead and log out because we are way over time. Thank you guys all for your questions. Thank you for watching. Make sure that you like, share, and subscribe. Again, if you do not have a copy of my book, you can grab one, How to Create Wealth by Jerry Fetta. And if you don't have that copy, you can get it free. You cover your shipping, which is $7.99. You go to www.jerryfetta.com. Have a great weekend. I will talk to you all next time.